Do your kids know they might have to pay thousands of dollars in taxes if you leave them your house or retirement account? Did you know new laws could make them take all the money out of your IRAs in just 10 years and pay a lot in taxes? And what if the trust you made to protect your home ends up costing your family more instead of helping them? Hi, I'm Judy. Welcome back to Reflections and Real Talk. If you want to leave your kids something after you're gone, like your house, retirement savings, or even the family cabin, this video will help you understand the new rules and save your family money and stress. Two big changes have happened that impact your estate planning needs. One is called the IRS Revenue Ruling 2023-2, and the other is the Secure Act 2.0. These affect how much your children will pay in taxes when they inherit property and retirement savings from you. Let's start with the IRS Revenue Ruling. A lot of families use something called an irrevocable trust to protect their home or savings. They can do this so they can qualify for government benefits like Medicaid if they need help paying for long-term care later on. Before this ruling, it wasn't clear if your children would get a step-up in basis on the value of your house if it was in one of these trusts. That step-up usually means your kids wouldn't have to pay taxes on how much your house increased in the value over time. But the IRS recently clarified that if your house is in a certain kind of trust that's not included in your taxable estate, your kids may not get that step-up. That means they might owe capital gains on all the appreciation when they sell it. And depending on how long you've owned your home, that could be a lot. Now, let's talk about retirement accounts. The Secure Act 2.0 updated the rules around inherited IRAs or individual retirement accounts and other retirement savings as well. Before, when your children inherited your IRA, they could spread withdrawals out over their entire life. That gave them decades to take money out slowly and pay taxes gradually. But the new rule says most beneficiaries now have to withdraw everything in 10 years. That means they could end up paying big taxes during their peak earning years, especially if your IRA is large. This change doesn't apply to spouses, minor children, or beneficiaries with special needs. But for adult children, this can turn into a tax nightmare. And this isn't just a federal issue. Every state has different tax laws too. Some states charge estate or inheritance taxes, others don't. In California, for example, there's no inheritance tax, but Proposition 19 created strict rules around keeping low property tax assessments. If you leave your house to your child, they have to move in and make it their primary residence within 1 year if they want low property taxes. Even then, the house's assessed value can only go up by $1 million, and many homes are worth well more than that. Anything above that gets reassessed and taxed higher. So even if your home stays in the family, they could be paying much more in property taxes. And just to clarify, yes, in California, the law allows for up to $1 million difference between the taxable value and the market value when your child inherits your home, only if they live in it. Otherwise, they lose the tax break entirely. Here's a real-life story so you can see how it really impacts people. I had a friend whose mother left her a home in a trust. She thought everything was taken care of, but after the mother passed, the family learned the house was in an irrevocable trust that did not qualify for a step-up in basis. The home had doubled in value and they ended up owing tens of thousands in capital gains taxes. They were heartbroken both emotionally and financially. Another friend of mine relayed a story where one of their relatives inherited a family cabin that was very sentimental for them. It was part of a trust, but because of the new Secure Act rules, the IRA that was paying the property taxes had to be emptied in 10 years. The family wasn't prepared for the tax hit and they couldn't afford to keep the cabin. It had to be sold. These stories are all too common. So what can you do now? Before I share some simple steps with you today, I want to let you know if you don't have a will or trust in place, you really need to check out my video called No Will, No Trust, No Way. In it, I explain what happens when you pass away without these documents and how it can leave your family in a legal and emotional mess. So if you're still trying to figure out where to start, watch the next one. I'll link it in the end of this video and in the description below. Now, back to what you can do today. First, talk to an estate planning attorney. Make sure your trust is the right type. A grantor trust might help your children still qualify for a step-up in basis. If your current trust isn't set up this way, it might be time to update it. Next, look at your retirement accounts. Consider converting some of your traditional IRA into a Roth IRA. You'll pay taxes now, but your kids could receive the money tax-free later. And that could save them a lot, especially if they're in a higher tax bracket when they inherit it. You can also give while you're still here. The IRS allows you to gift up to a certain amount each year per person without triggering any gift tax. That means you can start passing along wealth gradually and see your loved ones benefit while you're alive. Also check all your account beneficiaries. The people listed here will inherit those accounts regardless of what your will or trust says. Make sure they're up to date and reflect your wishes. And finally, talk with a financial advisor or estate planner who knows the laws in your state. They can help you create a plan that works for your unique situation. You don't have to figure this out on your own. I also made a free summary of this video that you can download to keep or share with your family. It's linked below the video. Making a plan now saves your family time, money, and stress later. It helps you leave behind a legacy, not a tax mess. And that's what we all want, to be remembered for love and care, not confusion and costs. If you found this helpful, give it a thumbs up and subscribe to my channel. Don't forget to check out my other video, No Will, No Trust, No Way, and download your free summary while you're there. I'm Judy, and this is Reflections in Real Talk, helping you plan smart, retire with peace of mind, and leave a legacy that truly matters.